my name is Kathlyn. In this video, I'll be sharing with you 3 leverage instruments, which is CFD, options, and futures. And which one of these will provide you better returns as well as protection. So let's start with the objective, right? I will be sharing with you an overview of the major leverage financial instruments, namely CFD, options, and futures, and more importantly, on how to choose the right instruments that suits you. And towards the end, I will also be helping you to understand what is the right framework to approach the financial market so that you can reduce your learning curve and to maximize your success. All right, so let's start with the big picture. I've recorded a video earlier, which is part 1 of this big picture here. So in case you missed the part 1, do refer to it because I explain the various asset types that's available for you to invest or trade, and also the various financial markets, right, in the different countries, and the various trading styles that you can choose from. I've also explained what is direct and indirect way where you can invest or trade in the stock market. So in this series now, I'm going to share with you what is CFD, options, and futures, and the contrast between them. Since this topic is about leverage financial instrument, so what is leverage, right? Leverage is a way for you to use less money in order to invest or trade the particular asset type. Example, right? If there's $100 stocks, instead of paying $100 in order to invest or trade, you could have paid less money. And depending on which instrument you're using, it can range from between 2% to up to even 50% of the actual underlying asset, for example, the stock price. So different instruments require different margin requirement or different leverage requirement. So let me give an example, right? If you buy direct stocks, let's say a stocks that costs $100 for every share, then you have to pay $100 in order to own a unit. But if you use stocks with margin that is provided by quite a number of brokers, especially in the US market, all they require is for you to pay a 50% deposit on of the stock price in order to trade the instrument. And if you do not keep it overnight, that's called intraday trading, they only require 25% of the stock price, because if you do not keep overnight, the risk for the broker is lesser. So it requires less margin. So a $100 stock price will only end up requiring a $25 to trade it. Yeah, this will make it more affordable, right, for people to trade the instruments. And the next instrument that requires less money is called CFD, which stands for contract for difference. I will explain more on this later. Depending on which broker and which country you are trading, the requirements for the margin is different, right? So it can range from a minimum of 20% all the way to even 90%, depending on the volatility of the instrument. But for index, because index is a basket of stock, it's more stable, it's only about 5%, yeah, of the index price. Next to it, we have options, which only require about 2 to 15%. Of course, there are more sophistication. So this is just a rough range for you to contrast. And there's also another instrument called futures, right? Futures is a more complex instrument. So depending on which commodity of index that you trade, the margin requirement will be different. So I will explain each one of these in a separate slides. So why do we need margin? Right, the original asset type can be expensive for quite a lot of people. So in order to make trading affordable, a lot of traders use margin, right? There's 2 benefits for it. One is you use less money. The other way is you improve your return of investment because you use less money, but when you have the upside, you still gain the actual upside as compared to trading stocks. All right, Cliff, so let's start with the first instrument, which is one of the easiest instrument among these 3, CFD, options, as well as future. CFD stands for contract for difference, right? The term implies there is a contract and you are trading the price difference, the price movement. So the technical definition for CFD is a financial contract that allows you to trade the difference of the asset type, that means up or down, without actually owning the asset. So what it means is when you buy a share, right, you are becoming a shareholder of the company. So, but not many people are interested to be a shareholder of the company. You know, for example, like the additional advantage you get is to attend the annual general meeting, right? To have the rights, voting rights. But most people join the stock market, like just to make money, right? They're not interested in having a voting rights. So having a voting rights doesn't give you a lot of additional advantage as a person who just want to make money in the stock market. So CFD allow you to be able to make money and yet make it affordable. So the key is between buyer and seller, right? If one person thinks that the stock market will go up, the other person thinks that it's time to sell the stocks, then these 2 persons can enter into the contract to trade the price difference. So CFD, options, and futures are called derivative instrument. This is a technical jargon, but let me keep it simple for you. Derivative means it doesn't have a standalone price. The price references the underlying security. Let's say you trade a CFD on Facebook stocks, right? So the CFD price will be closely related to the price of the Facebook stock. That's called the underlying asset type. So if you are trading gold futures, right, then you'll be referring to the a reference to the gold current price, spot price, and also the future price. Okay? So this is one of the reasons, right? So there is a high correlation between the contract price as compared to the actual underlying stock price or commodity price or the index price. We call that underlying asset price. So this is just a technical jargon. So you don't have to understand all this jargon for a start. This is to give you an overview of the contrast on what these three instruments can do for you so that you can decide whether this is something that you want to understand further. Okay. One important distinction between CFD options and futures is CFD does not necessarily need to be routed to an actual stock exchange or futures exchange, right? So it can be just between a transaction within the broker itself. Example, you can be buying a CFD with the broker and the broker will sell it to you, okay? So they become the seller to you, or what we call a counterparty. Nothing needs to be routed to the stock exchange, but this is not the preferred CFD type that I will recommend, right? There are brokers that offer what we call a direct market access, where they actually buy the stocks behind the scene. To you, it's a CFD, but the broker actually buy the underlying asset, right, via the stock exchange. This will be the preferred type of CFD implementation because you will get the exact quotes in the stock exchange and the broker cannot manipulate the price. Okay. Right, so let's put this in more layman example. So what can you do with CFD, right? So the same as stocks, right? In the US market especially, you can trade up or trade down. So example, there's a technical term here called long or short. Long means you buy low and sell high and you make money on the way out. That means you buy when the stock is lower and when the price goes up, you sell it and you make money. But you can also benefit from the downside market, which is, let's say you know that one of the stocks is going to go down, right, for whatever fundamental or technical reasons, then you will sell it first. Selling it to make money on the way down is called shorting because you don't have an actual stock first. Okay, so you are short of stock. So you sell first, and when the stock go down, let's say you sell at $50, when the stock goes down to 30, you buy it back. And so you will make $20 from it. Yeah. Example over here, you sell it, example, when it's 50, when it comes down to about $30, you buy it back and you make about $20. So this concept is new to a lot of people, yeah, but it's actually very popular to a lot of experienced traders called shorting. In this way is where you can make money in any market condition, not just trade up, right? Because the market is not up all the time. Sometimes the market goes down. So by using stocks or CFD, especially in the US market, you can trade up or down. But in certain markets, for stocks, you can only trade up but not down. CFD is a two-way direction that you can trade. So in an uptrend, you will buy low, sell high. In a downtrend, you will sell high and then buy back low. So let me just put a contrast between stocks and CFD. Let's say you want to buy Facebook stock, right? When Facebook stocks go up $1, you will make $1. But instead of buying Facebook stock, you're buying Facebook CFD instead. Okay? So when Facebook stock go up $1, you still make $1. And when Facebook stocks go down $1, you still lose $1 for the Facebook CFD. The contrast here is when you buy Facebook stock, you need to pay 100% of the stock price. Whereas for CFD, you just need to pay about 20% of the stock price, or 5% of the index like S&P 500 CFD. So the power here is the leverage, right? It make it more affordable, and your return of investment will become 5 times more, yeah, because you pay 1/5 time of the stock price. This percentage here can differ depending on the volatility of the stocks. For stocks like Tesla, the percentage requirement will be higher because the stock is more volatile. That means the up and down prices more in a day. And different broker may have different requirement for this margin requirement. And different countries' regulatory body may impose different minimum requirement. Okay, this is to safeguard investors and traders. So if you want to trade this instrument, make sure that you understand it properly, right, before you actually trade it. Okay, so as you can see, CFD can be a very simple instrument for beginners as well. So the next instrument I'd like to share with you is options. So what is options? Right? An options contract is an agreement between two parties, a buyer and a seller, right, to buy or sell the underlying asset. In this case, the underlying security or asset can be a stocks, can be a commodity, can be an index. Okay. The agreement is to buy or sell it at a predetermined price upfront. Okay, example, I want to buy the stock at $100. Okay, that is referred to the strike price or exercise price. Prior to or on an expiry date, that means there's an agreement to buy, let's say, the stocks on or before an expiry date, like 3 months. Okay, so there are many choices of the price that you agreed upon between the buyer and seller, which is governed by the specific exchange, options exchange. So there's a list of standard prices that you can choose from. And also there are many expiry dates that you can choose. This is also called a derivative, right? Because it doesn't have its own standalone price. It's derived from what the actual underlying asset price is. And options is an exchange traded instrument. And because it's exchange traded instrument, the price are standardized, yeah, across the exchange. In order to understand this further, I will share with you there are two basic options type. Okay, one is called a call option, and the other one is put options. In simple layman usage, right, call option is for you to trade up and put option is for you to trade down. But there are many other usage of call and put options. The simplest way for students to learn about options is starting with call option. So what is a call option? When I buy a call options, right, it gives the buyer or myself the right, but not the obligation to buy the underlying asset at a certain price on or before an expiry. Right? This could be a bit technical for you to remember. Let me put this in more a layman example. Let's say you want to buy a stock that's worth $100. So instead of buying the stock upfront at $100, you buy an options a call options that give you the right to buy the stock later. So right now, you are just buying the right to buy later, which is much cheaper than buying the assets straight away. Okay. Example, right? You can say $100 stocks. I want to have the right to buy these stocks 3 months from now, okay, at $100. So with this, you'll be paying a premium to do that. So the premium can range from between 2 to 10%. It depends on how long is the duration. The concept is a bit like the housing market. Instead of buying the house at full price, you enter into a contract, which is like a booking fee. You pay a 10% booking fee, and that gives you the right to buy the house later, right? But upfront, you only pay 10%. So at the end of the 3 months, you still need to pay up the remaining, either through a bank loan, right, or through remaining cash. Okay? If the house price increase, right, in between that period, after you have paid the booking fee, the seller cannot raise the cost of it anymore. Okay, so they have to agree to sell you at that contract price, right? That's the benefit of it. So let's say $100 stocks and you pay $10 for it. Yeah, $10 at 10%. So if the stock price go up to $120, you still have the right to buy at 20. So let me give you this example. I say $100 stock price. If you were to pay a $10 to trade this $100 stocks, when the stocks become 120, right, you still have the right to buy at 100. Okay, so earlier you only paid $10. Yeah, so you only lock in $10 in order to make the upside of $20. Can you see the difference here? Yeah, of course, there's more sophistication behind the implementation of it. Yeah. So what is the key advantage here is you don't lock up that much amount of money. And the other big advantage is because you only pay 10% deposit, okay, or we call it options premium, the most you can lose is the deposit. You will not lose more than what you pay. Whereas if you buy directly the stocks, right, of $100, your downside can be up to 0, right, if the company go bankrupt. Okay, or if there's a downside of 20%, you will lose 20%. But in options, by buying a call options, you will only lose whatever premium you pay as long as you are the buyer, right? If you're the seller, you are also subjected to unlimited risk, right? So it's always good for beginners to start with buying a call option. The main benefit as a buyer of a call options is the limited risk feature, limited to whatever you pay. So how much is the premium? It can range from 2 to 15%, yeah, depending on how long the expiry and also the exercise price. So then what is a put options then? A put options is a way of protection, right? It's a way for you to trade down or to protect your stocks. By buying a put option, it gives the buyer the right, but not the obligation to sell the underlying asset at a certain price on or before the expiry. So there are many usage for this. Put options can be used to protect the downside of the stock. Example, let's say you bought a stock at $100, right? But you're worried of the stock market crash. So what can you do? You can buy a put options, which serves like an insurance, right? So by paying, depending on how long you want to protect, let's say, if you want to protect just for about 2 months, right, from a potential market dip, market crash, then you can pay roughly about $3, right? It differs depending on the stock price and how long you want to protect and how much you want to protect. So assuming you pay $3 to buy put options, then you have the right to sell the stock at the protection price. So in this case, if you want to protect your stocks at $100, then you can buy an options with the exercise price of $100 or strike price, we call it, yeah. Then before the expiry, you can say, I want to protect for 2 months. So these options will cost you roughly about $3, just to keep it simple. By paying this $3, you are like buying an insurance and you can have a peaceful night's sleep. Because no matter what happened in the market, you still have the right to sell your stock at $100 right now. Can you sleep well? Okay, so it's just like car insurance, right? You pay about 3,000, to insure a car of 100,000, and if your car disappear or get an accident, right? So you can still protect your entire car value or the amount that you want to protect. So these are the basic call and put options. But when you combine the many different call and put option contract, it can end up very, very powerful. Right? Options is one of the most powerful financial instrument among all the instruments that I've traded. By creative use of combinations of call and put options, and between 2 call options and 2 put options, or you can even go for 4 call options and 4 put options, right? It can lead to thousands of possible combinations. But this instrument is more sophisticated. So I would suggest for beginners, you need to understand the stock market first, right? Trade stocks directly first, and you can use CFD to make it cheaper, more affordable. Then only you go for options. Yeah. But I would, if you are more ready to, you have already traded for quite some time, you understand how the stock market works, you understand fundamental and technical, right? And you already have a consistent trading strategy, then it's time to learn up options. Yeah, options is my favorite trading instruments. In what context that people use options? There are many ways people use options. One of it is someone may be bullish and someone could be bearish on the stocks, right? So let's say someone think that Facebook stock will go up, they will be a buyer of a call option. The other person who sell the options to you may be thinking that Facebook could be sideways to down. Okay, so then there will be a deal, right? The broker will connect the buyer and seller, right? And this transaction will be routed through the stock exchange. So a lot of people are trading options right now. So the options volume have gained a lot over the years, but it is still about 10% plus of the people who are trading the stock market. Yeah, because it's a more sophisticated instrument, and a lot of people are still not into stock market yet. Yeah, so hopefully in the future, right, the trading volume for options will become higher and higher. So now that you understand briefly what is options, so why options, right? As I mentioned earlier, options is the most powerful financial instruments. Okay? What's the main reason? First is the most important benefit of options is limited risk if you are a buyer. So this gives you much better protection compared to stocks or CFD. The reason is you can predefine your max risk upfront. Yeah, so you can say, okay, if these options cost you $3, right, and it goes in contract, one options give you the right to 100 shares. So you always need to times 100 to the value that you see on the broker quote. So let's say it's 300. The most you will lose is 300. Yeah, you know that upfront, you can sleep well because then you know, okay, can I afford to lose this 300? And there are many, many ways to protect, so many ways to trade options. So you can have a way to protect over earnings for specific stocks. You can protect your entire portfolio, right? You can just use a limited way to keep overnight, right? You can trade for 1 week, you can trade for 1 month, you can keep for long term, right? So many ways to trade. And it's the most versatile instruments because it provides you many ways to trade the same chart. Yeah, because there are multi-directional way, which I will show you on the next diagram. You can also tailor the best fit strategy for the trade scenario. This specific market sentiment could be volatile. Then you will use a specific trading strategy. If you want to leverage on the pre-earnings rally, right? Before earnings announcement, typically there will be a market rally for that specific rally for the specific stock. So you can use a different trading strategy. If you want to trade breakout, right? Breakout, it could be big upside or downside on earnings. There's a trading strategy for that. If you want to trade range bound, there's a strategy for that. Okay. And you can increase your investment returns mainly because it's the leverage is actually even better than CFD. Yeah, so it's because it's between 2 to 15% of stock price, while CFD is at least 20%. Okay, so you're using less money to trade, right? And you can make money in more than one direction, right? So there's a strategy where even if the stocks don't move, right, as long as it stays above a support level, a certain level, you can make money from that. So you have multiple ways to win. So this is one way. Even when stocks stay sideways, you can there's a way to even collect rental income, yeah, from the stocks. Like when you buy properties and you rent it out, right, you get a monthly income. In options, you can do that, right? So you can buy stocks and sell monthly options, right? And even though the stocks don't move, you will collect the options premium. Yeah. So of course, you need to understand it properly before you trade. And there's also a way to reduce the cost of your entire investment or trading, right? So if you're investing in $100 stocks, you will need to pay $100. But if you use options to invest for the long term, let's say you want to keep the stocks for at least a year, right? Then the 1 year options typically range from about 8% all the way to 15%. Yeah, it also depends on how volatile the stock is. So you're only using roughly about 1/10 the stock price. And because of that, you also limit the risk to about 1/10. Yeah, that's the main reasons why I would suggest you to master options once you can understand the foundation of the stock market. Okay, so this is another pictorial diagram to share with you how many directions you can make money from options. Yeah, first is there's a way to make money on the upside. right? Which is buying a call option. And if the stock is going down, you can buy a put options. Another second way is you can win in multiple directions. If the stock stays sideways, right, sideways to up, you can still make money. Right? If you're using stocks or CFD, the stock has to move up for you to make money. But if you use options, there's a way to make money, even though, let's say, when you enter the stock, it was $100, end of the month is $100, you can still collect an options premium for it. Yeah. So there's a way to trade sideways up or sideways down market, and there's a way to trade breakout. Yeah, and there's a way to trade range bound. Of course, there are many other possible combinations. The name options imply there are many options, right? Many ways to trade it. However, I'd like to remind you that there's a steeper learning curve to pick up options, but it is all worth it, right? So do plan it in your trading journey down the road, but do master the foundation first. Then there's another more advanced instrument called futures, right? So what is futures? Let's share the technical definition first, right? A futures contract is a legal agreement, okay, to buy and sell. It's also between two parties, buyer and seller, right? To the agreement to buy or sell a particular asset type, right? This could be a commodity, right? This could be a stocks or an index, right? At the predetermined price. It's just like options, right? You agreed to buy or sell at a certain price and a specific time in the future. Okay. Futures contracts are standardized to facilitate the buying and selling. So standardized in terms of quality and quantity. Okay. And these are all exchange traded. It is also called a derivative because it don't have a standalone price. So let's say you are buying oil futures, right? You can be buying oil March futures or June futures, but the underlying will be what is the current oil price, right? Then depending on how long you keep it, there will be a markup to the current oil price, or sometimes could be marked down. And different commodities or index futures has its own range of expiry date, right? Some has a monthly expiry, some has a 3-monthly expiry. Okay. All right. So how much does it cost, right, to trade futures, right? This is a more expensive trading instrument. So I just want to give you some idea. How much is one contract, margin requirement? So there are many different assets and index that you can trade, and they are all different requirement. There are metals, energies, plantation, and so on, right? So these are metals, right? Example, gold, silver, copper, right? Platinum, and so on. So just forget about the symbol for now. So what is the initial margin? Initial margin is the amount that the broker require you to have in account in order to buy one contract of futures. So you can see it's actually can be quite costly to some people, right? One gold futures contract is $8,250 US. Okay, so this is called the initial margin. And once you enter the positions, you need to make sure that it doesn't drop below 7,005. Yeah, otherwise you need to top up your account. Otherwise it's called a margin call. But if you are not keeping overnight, that means you are doing intraday trading. You buy and sell within the day, not keeping over the trading days, then the margin requirement is just 50% of the initial. That means 50% of this initial margin, which will end up 4125. So depend on which futures instrument you are trading, the requirement is very different. For example, there's a gold and a micro gold. Yeah, so micro gold is a smaller size, is a subset, like a fraction of the original gold contract. So in this case, it's 110. So the price for one contract is 110. The reason the exchange created this micro contract is to make it affordable for more traders. So you also have other micro contracts being introduced. So when you trade energies like crude oil over here, right? The symbol is CL. One contract is 5,610. Yeah. So when does people, just to give you another layman version of oil futures, right? How do we trade oil? Okay. I will share with you the commercial implementation first. The airline company like AirAsia, when they sell you the discounted ticket, let's say 6 months from now, let's say they are selling you a June ticket for next year, right? What will be the risk to them? Right? Let's say they sell a cheap ticket to you. What will be the major risk? Right? Will be the oil price. One of it is oil price fluctuation, right? Of course, the other one is the pandemic, right? Let's put aside the pandemic first. So just in case the oil price go up, yeah, especially with the pandemic recovery, so AirAsia can actually buy a oil futures contract to lock in the price. So if I were to go for March contract versus June versus September versus December, the price will be different. So that will be determined by where people think the oil price will be in the future, right? Let's say AirAsia wanted to sell you the June ticket, they will be buying a June oil futures, yeah. And so let's say this price is $70 per barrel, okay. By the time coming to June, if the oil price become $90, okay, assuming a lot of oil demand, it become $90, AirAsia still have the right to buy oil at 70. That's how they manage the risk of oil price fluctuation. Okay, but if oil price dropped to $50 by the time, they are still obligated. Right? The keyword here is obligated to buy oil at $70. Right? This is there's an obligation to fulfill the contract requirement. But at least from a commercial use, right? This is justified. But as a trader, right, it's different, right? You will need to make sure that you are correct on the direction. Okay, because if you buy oil futures at 70 and it end up dropping to 50, you will lose $20, yeah, per contract. All right, so you can see here the natural gas heating oil. There's also index future. That means you can trade the S&P 500 futures. It's called E-mini S&P 500, up or down, right? So every 1 point up and every 1 point down, right, it will be a different pricing for you to make money or lose money. So E-mini S&P 500, it's very costly to trade, 12,650 per contract. But they created a mini version. It's called micro contract, which is 1/10 the price, yeah? 1/10 the price. So this one is more affordable. So if you want to trade indices, I would suggest that you use CFD because it's so much cheaper, yeah, per contract. So there are also many agriculture futures that you can trade, like wheat, corn, soybeans, and so on. And the contract requirements are different. So wheat and corn and soybean are the more affordable contract. So that's futures. So I would not suggest beginners to trade futures. Because this is actually a more sophisticated, and typically is done by big institutions or more sophisticated traders. There are many underlying factors that affect the futures. And in order to trade a specific futures contract, you need to understand what actually affect that specific asset. Yeah, example, right? You need to understand what affects soybean, right? What affect coffee prices and so on. Yeah. Okay, so now, last but not least, I'm going to show you the contrast in one big table here. Okay, I'm going to touch on the high-level contrast only. And you can actually pause and read this and digest this in detail if you want to, right? So let's start with the ease of trading, right? So of course, stocks is the easiest to understand and to trade for beginners. And you can also use CFD because the CFD models stocks exactly, with the main exception, which is no voting rights and it's not exchange traded, yeah? So this is easier for beginners to start with. Once you understand that and you can trade for some time, and you can move to options, can be more sophisticated. And for futures will be more advanced. Okay. Then in terms of price movement, right, stocks is the actual price movement, and CFD moves similar to stocks. Options has more complexity. So the options price depending on what expiry you choose and what is the track price, or some people call it exercise price. For more volatile stocks, the premium is higher. Okay, less volatile, the premium is cheaper. So if you understand these aspects, then you can trade options. Yeah, and within options, there are many different ways to trade. We call it different trading strategies. Whereas for futures, the price movement is affected by several factors like expiry, and more importantly, the projection of the future commodity or indices price. Okay. Then in terms of whether it's exchange traded, all stocks, options, and futures are traded via the exchange, which means you can get a standardized price and there's higher volume. Whereas for CFD, it's not exchange traded. You can see the leverage difference over here, which I've covered earlier. In fact, the the best leverage is from options, yeah, it's 2 to 15% only. And the most powerful instrument here, where you can trade more than 2 directions, most of this instrument you can trade up or down, but options allow you to trade in even sideways, make money even when the stocks don't move. For dividends, if you are buying options and futures, there's no dividend. And in terms of expiry, right, stocks and CFD has no expiry, so you can buy and hold it for long term. Whereas for options and futures, there's an expiry. So if you want to keep for long term, you need to do something called rollover. When it's close to expiry, then you need to buy the future contract, yeah, extend it. Yeah. And for intraday trading, you're doing intraday trading, you need to understand that some instrument has a restriction for minimum capital for intraday, like 25,000 US dollar, right? For US market, for stocks and options, you need to have a minimum 25,000 account so that you have unlimited intraday trade. Otherwise, you are limited to 3 intraday trades in 5 days. Okay, so if you are active intraday trader and your account size is smaller, then you can use CFD. So in conclusion of this comparison, if you're a beginner, right, I would recommend you to start with stocks and CFD first, right? So if your capital is higher, you can still afford to trade stocks or stocks with margin. Most brokers give you a 50% margin requirement to buy the stocks. But if your account size is low, right, how low is considered low? Like less than 25,000 US dollar, then CFD will give you much more affordability to buy stocks, and you can diversify with lesser capital. Right? And once you master this instrument, and as your account size go higher, then you can go for options. Yeah, you don't actually need to trade futures. Right? Just to clarify, even one instrument itself can help you to make money. But if you use leverage, it will help you to compound your money faster. Okay. So if you are interested to understand more, I would suggest that you need to go through a proper education so that you can reduce your learning curve. And we have a systematic approach to the financial market, which I will cover in the next slide. How do you approach it? Once you choose, let's say, the stock market and a specific trading style, how do you approach it? There are actually 4 basic principles that I use. Right? The first one is, just see an example of a stock market, is how to select the right stock. Right? So you start with selecting the best stocks in a market, but you don't buy it yet. The next step is to time it, right? After you select the best stock, when do you get in and when do you get out? So that's called timing. Next is, how much do you buy? That's for protection. You don't put all your egg in one basket. And how do you manage the risk, right? So we have something called a stop loss. It goes below a certain level. Like I only risk less than 1% of my capital at any one time. And I don't have more than 5% concurrent market risk overnight, right? So this is one example of the protection. So once you have this, you're already protected and have good repeatable methodology, then you can go for multiply, using some leverage instrument to make it more affordable and to make it faster. So we have another seminar that cover this in detail, which is about 2.5-hour seminar if you are interested to understand more about this. And just to give you some idea about where we are coming from, we are actually a very established educator in the financial market. As you can see over here, we have a very structured methodology to teach our students. Overall, we have 5,000 plus graduates already across Malaysia, Singapore. We have students in Vietnam, Hong Kong, Australia, and New Zealand as well. Our company started way back in 2008, and over the years, we have been awarded many different awards, like top financial training company in Malaysia in 2013, and also the most preferred financial educator in the Invest Fair for 3 consecutive years that we participate in that forum. Okay, and this is our key differentiator here. We, as a company, we have the most experienced coaches, right? No company out there has 29 coaches, okay? Most of them has just a few coaches. And this actually helps us to have a good coach to student ratio to support our student effectively. And we have the most effective support in the market, where we have a lot of hands-on tutorials, guidance, and automation to help us to analyze whether our students have followed our methodology correctly, right? Automated templates and so on, with a lot of statistics of their performance. And the last but not least, we have the most comprehensive and systematic curriculum you can find in the market. As you can see here on the diagram, all the way from the foundation of the stock market to the different trading style, right? We have long-term investing, swing, trend, and intraday approach in a systematic progression to build a strong foundation. We also have instruments like CFD and options, and we go to even for total beginners all the way to very advanced students. We still have something for you. For example, whether you want to understand the overall industry as well as the macroeconomics perspective that influence the stock market. We are also one of the company in Asia, the only one in Asia that has a master trader bootcamp focusing on trading psychology. How do you become a master trader, right? You have to control your greed, and there's a lot of psychology aspects that you need to master to create a consistency. Okay, so if you are interested to learn more, do join our next free seminar. It's 2.5 hours, and this is where you can register, or you can scan this QR code to register and find out more about our courses. Okay, so I look forward to see you in our next seminar.